Here are 3 strategies that you can do today if you're worried about the economy or losing your money in the stock market. Here is strategy 1. If you have money in the stock market and you're worried about losing money, the most basic strategy that you can deploy is what's called a covered call. If you've never done anything in options, or you may have heard bad advice that options are just risky, they're not. It's actually an insurance product, also known as a derivative of the underlying asset, meaning the security that you own. So let's just say, for example, this is XYZ stock. It could be Disney, it could be ExxonMobil, whatever it looks like. This stock right here, what you're going to do is, if you're nervous the stock is going to go down, which stocks have been doing recently, you can sell calls against it. Calls are typically options that people buy when they think the market's going to go up. Well, in order to buy that call, someone has to sell it to them. By capping the gains, you're basically selling at an out-the-money price. So say the stock is $100 today, but you think it's going to go to 90. Well, you could sell it today at $100 or $105, and there is premium that will be paid to you by the option buyer, or the call buyer that is, that pays you legitimate money. So as your stocks potentially go down, you've made money by selling that call. It seems a little complicated, but the more I would explain it to you on another video, it will start to make more sense, and it's a way to preserve or hedge capital in this down market. Strategy number 2, again, you don't have to panic and just watch your money go down. You can do what's called a married put. So the difference in a call is called a put. If you think a stock is going to go down, you would buy a put, not a call, because puts basically go up in value as a security loses value, very similar to selling a stock short. So if you think stocks are going to go down, which they've been doing, in the future, you can deploy this strategy by buying or marrying puts to your position. I know it seems counterintuitive, like why would I want my stock to go down by buying puts when I want it to go up, Matthew? Well, a lot of puts can be cheaper because you can buy the puts out the money. So say your stock is 100, you could buy a cheaper, meaning a lower premium put strike, say $90, a couple weeks out from the option expiring, and therefore if the stock does drop, the premium goes up in value, and then you can sell the put later, take those money or gains and roll it back into dollar cost averaging your stock. This is what's also called a married put. And the third strategy that you can deploy is a little more complicated, but it goes with a married put as well as a covered call. So say you own that stock for $100, you could sell a covered call for that stock and sell it at $110 and say it nets you out a premium or some income. Then you can take that income and buy a married put at $90 from the premium collected by the covered call. So as the stock goes down, your put goes up in value, and it's been paid by the covered call you sold. So again, there are many ways to diversify and not just look at your stock account and cry, oh my God, I'm losing all this money. So in closing, you guys, if you've seen any of my past videos, you know that I'm an active options trader. I like to sell or write a lot of my options, but any of these strategies that you can deploy yourself for your own wealth portfolio, or if you're just trading stocks in general, again, it doesn't have to be a situation where you feel super vulnerable. You're looking at your stocks day in and day out and they're just going down. You do have options, again, no puns intended, that you can deploy and strategize to hedge against these down loss days. So again, if you have any questions about options, let me know in the comments below. As always, I hope this video gives you guys a lot of value, and I will see you guys on the next one.